90% of real estate investors never hit true financial freedom because they chase just one shiny metric, cash flow, appreciation, whatever, and completely ignore the other two. That kind of single-track thinking is why most investors get frustrated and throw in the towel. Today, I'm not just giving you tips, I'm handing you the missing pieces, the triple crown of real estate investing. When you combine appreciation, cash flow, and strategic debt the way the top 1%ers actually do, you transition from active investor and you start building a passive investment empire, one that truly compounds while you sleep. So stick with me for just a few minutes and I'll share exactly how you can get into the winner's circle too. Here's the problem. Most people dive into real estate with a really narrow lens. Take investor number one. They snag a cash flow king duplex in the Rust Belt. Yes, it might bring in $350 a month after expenses, but values barely crawl at 2% a year. Their initial capital is just sitting there, not truly compounding. And let's be honest, the tenant base often treats the place like a frat house. Then there's investor number two. They jump into a sexy value-add syndication deal in a hot market, mesmerized by the projected equity multiple. Yet they still have no cash flow for 2 years because the renovations and stabilization take longer than planned. Both of these investors, they'll brag about their one metric in a Facebook group, but neither is any closer to building real, lasting wealth. One has stagnant capital, the other is cash-strapped and equity-stuck. They're not climbing a mountain, they're stuck jogging on a treadmill, wondering why they're not seeing any real progress. It's frustrating and it's completely avoidable. Now, picture the three legs of a sturdy stool. You remove just one, and what happens? The seat hits the floor, right? That's exactly how your real estate portfolio works. Appreciation is the leg that quietly grows your net worth in the background. It's the silent wealth builder, doing its work year after year as the syndication's business plan unfolds. Cash flow is the leg that sends you a distribution check every single quarter. It's your oxygen, letting you live, breathe, and reinvest without stress. Debt, and this is key, used correctly by the professionals you partner with, is the leg that multiplies your returns and lets inflation do the heavy lifting, while the tenant's rent payments work the night shift for you. When all three of these legs are sized to the same height, the stool isn't just stable, it can hold an infinite amount of weight. Miss one, and you'll be wobbling, feeling unstable, and wondering why your portfolio statement looks less like a steady climb and more like a cardiogram. Pillar one, appreciation. Appreciation is simply the value of your asset going up over time. It's that beautiful phenomenon where the apartment community you invest in becomes worth more tomorrow than it is today. Historically, national commercial property prices have climbed steadily over the long term. But here's the secret. Smart syndicators don't just ride the market. They force appreciation for their investors. How do they do that? Imagine partnering in a deal to buy a 200-unit 1980s apartment complex with rents well below market. The sponsorship team uses investor capital to add stainless appliances, vinyl plank flooring, and in-unit laundry. Then they raise each unit's rent $200 a month. At a 5 cap rate, that extra $480,000 a year in income is worth roughly $9.6 million in new value the day the new leases are signed. Your small piece of that deal just saw a massive jump in equity. That's not luck, that's strategy, and it's incredibly powerful. Pillar 2, cash flow. Cash flow, my friends, is oxygen. Without it, you choke the moment economic headwinds pick up or a capital-intensive project runs over budget. You need that consistent, positive income stream. So how do you calculate it? It's the property's gross rent minus all operating expenses, a healthy maintenance reserve, asset management fees, and of course, the big mortgage payment. What's left over is distributed to you, the limited partner. And it should still beat the 10-year treasury, or otherwise you're speculating, not investing. Let me give you an example. A syndication I invested in outside of Indianapolis brings in steady rents. After all expenses, my $100,000 investment generates about $8,000 a year in distributions. That 8% cash on cash might not sound like a home run, until you realize it's hassle-free passive income that lets me sleep soundly at night and bankrolls my next syndication down payment, all while my initial capital steadily grows through appreciation. Positive cash flow isn't just about profit, it's your recession moat. When values dip, you're still getting paid to be part owner of the place. You can calmly wait out the storm instead of worrying about your capital. It's financial peace of mind. Pillar 3, strategic debt. Most people hear the word debt and immediately picture maxed out credit card statements at 19% interest, right? Professional syndicators, however, hear leverage and picture something entirely different. A multi-million-dollar fixed-rate agency loan that never calls to ask for a raise. Here's the ultimate cheat code. Inflation erodes the purchasing power of dollars. That $150,000 monthly mortgage payment the property makes in 2040, it's going to feel more like $75,000 in today's money. Meanwhile, rents keep pace with wages and consumer prices, effectively cutting the property's debt in half on a real basis. This is the magic of debt debasement working in your favor. The trick is for the sponsor to use conservative loan-to-value ratios. Think 65 to 75% on large apartment communities. This amplifies your upside potential while shielding your downside risk. All right, let's look at some return on equity math. A sponsorship raises $4 million from investors to buy a $16 million property. Through their value add plan, they force $4 million of appreciation. The limited partner's $4 million in equity just became $8 million. Try that at your local savings bank. This isn't just about borrowing money. It's strategically deploying pooled capital to grow your wealth. Now let's talk synergy. Alone, each pillar is decent, yes, but together, they're almost unstoppable. Appreciation balloons your balance sheet, building massive equity in your deals. Cash flow keeps the engine greased, providing liquidity and covering distributions. And that fixed rate debt? It lets the sponsor execute a cash-out refinance to return a chunk of your initial capital, so you can go invest in syndication deal 4, 5, and 6 without ever having to sell your golden geese. Imagine you're an LP in 5 syndications with a total of $200,000 invested. They each generate an average 8% cash-on-cash return. That's $16,000 a year, hassle-free passive income. Now, property values bump up, adding another $40,000 to your share of the equity across the portfolio. And inflation, bless its heart, shaves another 3% off the real value of the loans, handing you another invisible win. Add those numbers up, and you have a massive effective return on your original invested capital. That's a powerful annual return without swinging for the fences in crypto or meme stocks. It's compounding at its finest. Here's a quick example deal. Just last spring, an LP invested in a deal for a 180-unit building in Tennessee for about $12 million. The rents were sitting at about 12% under market, and the sponsorship team raised $3 million from investors for the down payment. The LPs also funded a $450,000 CapEx budget for cosmetic updates. Think new countertops, smart thermostats, and keyless entry. The sponsor then pushed each unit from about $925 to $1,075. The property's monthly net jumped to about $18,000, meaning an annual extra of $216,000 in net operating income. The cap rate in that market is 6, so the forced equity gain is $216,000 divided by 6%. That's a $3.6 million value increase. The group's $3 million investment effectively doubled in equity in just over a year. Try doubling your 401k that fast. It's a testament to the power of this strategy when executed well. Now, the Triple Crown is powerful, but it is not a license to be complacent. You absolutely need guardrails as a passive investor. First, always keep 6 months of personal expenses in a high-yield savings account or short-term treasury bills. Call it your sleep well fund. Second, never invest capital into a deal that you couldn't afford to lose entirely if, God forbid, the deal went south. Third, look to invest with sponsors who target landlord-friendly states with diversified job bases. If the city only makes cars or mines coal, you should probably pass on it. You want economic stability. And finally, only partner on deals where a cash-out refi in the business plan still leaves the property cash flow positive at around a 1.25 debt service coverage ratio. Follow these rails, and you'll not only survive, but thrive through every bubble headline screaming across CNBC. Ready to put this into practice? Here are your immediate action steps. Number 1, pick a market with consistent population growth, strong job growth, and a diverse economy. This is where you want your sponsor partners to be hunting for deals. Number 2, screen sponsors and then deals. Find operators with a proven track record of executing this Triple Crown strategy successfully through at least one full market cycle. And number 3, analyze the underwriting. Learn to stress test a sponsor's pro forma. Question their rent growth assumptions and their exit cap rate. And look for a deal with at least a 6% preferred return. Number 4, favor deals with long-term fixed-rate debt. This protects the investment from interest rate fluctuations and allows inflation to work its magic for you. And number 5, for every profitable exit, roll equity into new deals. Do these 5 steps repeatedly, consistently, and the math will snowball faster than you can update your net worth spreadsheet. It's about building momentum. And if you want to keep that momentum going by investing in quality deals, just drop the words due diligence in the comments or click the link in the description below. I'll send you my free smart investing checklist so you can invest with confidence. Now let's talk about mindset. Trading time for dollars is a broken model, plain and simple. Start leveraging your income to own shares and assets that appreciate, cash flow, and have their debt amortized so you can focus on the more important things in life. That is the new model. Stop asking, how do I pick the next hot zip code? And start asking, does this syndication opportunity strengthen all 3 legs of my stool? When you view every potential investment through the Triple Crown lens, you'll confidently pass on 90% of the deals without heartbreak. And the 10% you do pursue will fund the life that you actually want. It's a complete paradigm shift that empowers you. So there you have it. Appreciation grows your net worth quietly but powerfully. Cash flow funds your lifestyle and gives you freedom and flexibility. And strategic debt compresses decades of work into just a few years. Put them all together and you've got the Triple Crown, an investment system that compounds relentlessly in bull markets and defends you like a fortress in bear markets. If you got any value out of this video, and I hope you have, do me a favor and like, subscribe, and hit that notification bell so you don't miss my next video. It helps the channel out and gets the content in front of more people. And please share this video with just one friend who still thinks real estate is just about flipping houses on HGTV. Let's stop building portfolios and let's start building a life we love. And as always, I'll see you in the next one.